Abans Investment Managers is the asset management arm of Abans Group. Abans Group over last 17 years have created many investment strategies across the use of derivatives, across the use of arbitrage transactions. This was initially used only and only for the proprietary fund management. So since 2019, the group ventured into external asset management vertical under Abans Investment Managers, wherein we are currently offering multiple products. So we have a dollar denominated arbitrage fund, which is Abans Global Arbitrage Fund, being offered through the Mauritius entity. It's a dollar denominated arbitrage fund which does arbitrage in commodities and currencies in the global market and has been delivering close to about 8% returns in dollar terms. The second product that Abans Investment Managers offers is the market-linked debentures or structured products, as it is popularly known in India. So these market-linked debentures have features of principal protection, participation-oriented products, and there are multiple types of products which are being offered. Abans Investment Managers has also been able to offer these products to the NRI investors or foreign investors through an alternative investment fund. Abans Investment Managers also offers a PMS strategy which is registered with SEBI, and the portfolio management strategy is Abans Smart Beta Portfolio, which is an algorithm powered PMS strategy wherein the portfolio of 10 stocks out of the Nifty Midcap 100 index stocks is determined on the basis of momentum in the market, and it's rebalanced on a quarterly basis. So it's a pure quant strategy that is being offered by Abans Investment Managers. What is active versus passive investing, and how does market-linked debenture as a passive investment instrument can help investors in their fund management? As you might know, an actively managed fund is where there is a fund manager who's actively monitoring the portfolio, making changes into the portfolio. Like if you invest into mutual funds or portfolio management service or an alternative investment fund, these instruments are called active fund management. If you buy stocks directly and manage your portfolio on your own, that's also active fund management. Versus that, if you invest into an index fund, which is actually mirroring the index itself in a fund structure, so that is called as a passive instrument, right? Similarly, a market-linked debenture can also be a passive instrument wherein the returns are linked with the Nifty 50 index or a stock or a commodity, and to that extent it can help in multiple ways. When you invest into any actively managed investment product, your objective will be to outperform the market. In technical language, it is known as alpha. How much more are you getting compared to the index is what you will look for when you invest into any actively managed product. A market-linked debenture by design can help you generate alpha. Say if you invest in a principal protected market-linked debenture, say for a 3-year tenure, and if the product says that if the Nifty from the entry point grows another 50% in 3 years time, at the end of the 3rd year, for every 1% you get say 1.3x, which is 130% participation. That is, if Nifty grows by 50% in 3 years, you will actually get 65% return. If Nifty grows say 10%, you get 13%. If Nifty grows 20%, 26%, so on and so forth. Because the participation rate is 130%, that is 1.3x of what the Nifty is delivering, that means you have a guaranteed alpha of 30%, which means how much will you outperform the market is actually known very much in advance, and it doesn't become a black box. Secondly, it also offers a feature of principal protection. In case if the Nifty index was to generate negative returns on a 2-year or 3-year basis, the face value of the debenture stays protected, which may not necessarily be the case in case of actively managed products. What is the difference between a debenture and a market-linked debenture? Hello, this is Bhavik Thakkar, CEO Abans Investment Managers. Debenture, as we know, is a debt instrument through which any corporate or an NBFC borrows money from the market. it carries a fixed rate of interest. Like if you invest into a debenture issued by say UP Power Corporation, it carries say 8%, 9% rate of interest. So the rate of interest in a normal debenture is fixed. What is also fixed is the frequency at which you get the interest paid out, whether you get it quarterly or a half yearly or a yearly payout, and you get the repayment of your capital at the end of the tenure. This is how a normal debenture works. Against this, a market-linked debenture is an instrument. It's a debenture instrument, but here the rate of return that you get, the coupon that you get, is not fixed. It is variable. It is dependent on the performance of the underlying index or a stock or a commodity. So if I say that the debenture is linked with the Nifty 50 index, based on the performance of the Nifty 50 index, the returns are determined. So that is how the coupon gets fixed for a market-linked debenture. What also happens in a market-linked debenture is that you get the entire coupon payment at the end of the tenure of the product, unlike a normal debenture where you get the coupon payout on a quarterly or a half yearly or whatever is the frequency, you get the payout accordingly. So these are the two major differences between a normal debenture and a market-linked debenture. Thank you. Let us understand what is market-linked debenture and how does it operate. A market-linked debenture is a debt instrument through which any corporate or an NBFC raises money from the market. The returns that you get on a market-linked debenture is dependent on the performance of the underlying index or a stock or a commodity that it is linked with. So if you invest in a Nifty linked debenture in say next 2 year, 3 year, based on the performance of the Nifty, you get your returns. Market linked debentures can be of many characteristics, such as principal protected market linked debenture versus non-principal protected market linked debenture. Let me give you an example. If you invest in a Nifty linked debenture which has a starting point of let's say 18,000, it's a 2-year investment. Say it says that if the Nifty grows another 30% in 2 years time, you will get say 1.3x or 1.4x of that, which is known as a participation, that you get 130% or 140% participation. Suppose the Nifty value at the end of the 2-year tenure is lower than 18,000, that means Nifty has generated negative returns. So if you would have invested in an MLD which is principal protected, then in that case you don't lose part of the face value of the debenture that you invest with. So that works like a principal protection for your capital. If the same instrument was not to be a principal protected instrument, then the loss that you have on your investment, say typically similar to the index loss, right? I mean, whatever index loses, you also lose that value. This is the one of the important characteristics in terms of principal protection versus non-principal protection. The market linked debentures could be rated versus unrated also. That means the rating could be done of the instrument by the credit rating agency. They can be listed or unlisted also. A listed debenture is typically listed into a debt segment of Bombay Stock Exchange or the National Stock Exchange. When an issuer offers principal protected market linked debentures, let's understand how does the issuer ensures that there is a principal protection in place. If you invest say 100 rupee into a market linked debenture issued for a 3-year tenure with principal protection, and let's say it is linked with Nifty 50 index, saying that if Nifty goes up another 50%, you will get 1.3x of that. That means if Nifty goes up really 50% in 3 years time, you get 65%, which is 1.3x, 130% of whatever Nifty delivers. So typically, to ensure that there is a principal protection achieved, how does the issuer ensure principal protection? When you invest 100 rupee in a principal protected market linked debenture, on 70 to 75 rupees, the issuer will try to generate fixed return. So let's say if 70 rupees is deployed at say 12.5% rate of interest for 3 years, it will become 100 at the end of 3 years. So that ensures that the principal protection is in place. The remaining 25 rupees is used for investments into Nifty derivatives which will actually generate Nifty link returns. So at the end of the 3 years, if the Nifty index is lower than where it started, let the 25 rupees become 0, but the 75 that has been invested or lent out by the NBFC at 12-13% rate of interest will become 100 at the end of 3 years, and that will be used for protecting the principal amount that the investors have invested. With effect from 1st of January 2023, SEBI has reduced the face value of privately placed securities from 10 lakh rupees to 1 lakh rupees, which means market linked debentures which are issued on a private placement basis can now be availed at a ticket size of 1 lakh rupee instead of the earlier requirement of rupees 10 lakhs. What is Nifty Maximizer MLD? The objective of Nifty Maximizer Market Linked Debenture or MLD is to provide maximum possible upside of Nifty with a given level of participation. Suppose you invest into a product which says that in 3 years, if Nifty goes another 50% up, for every 1% you will get 1.3x, which is 130% is the participation. But it will give you up to 50% growth in Nifty in 3 years. That means you get maximum 65% return. Another feature of this product is also principal protection. When you invest 100 rupee in this product, the issuer will allocate say 71 rupees to be deployed at 12% rate of interest. Say as an NBFC, 12% is the rate of interest that it will generate on the lendings that it will do, right? So when you grow 71 rupees at 12% rate of interest for another 3 years, it will become 100 at the end of 3 years. So this component helps protect the principal. The remaining 29 rupee out of 100 will be deployed in the Nifty derivatives in such a way that if Nifty grows another 50% or anything up to 50%, for every 1%, the product will deliver 1.3x. That means if Nifty indeed goes up another 50%, the 65 rupee cash flow will be available from the remaining 29 that will be deployed in the Nifty derivatives. The derivative component is managed in such a way that even if the 29 rupee becomes 0, the 100 rupee that you receive from the 71, which is used for the lending activity, will ensure that there is a principal protection. So let's say in this Nifty Maximizer example that I gave you, 1.3x participation or 130% participation to Nifty, which means 30% outperformance to Nifty. The alpha is guaranteed by design, and that's a very important, powerful tool, because when you invest any funds anywhere, your objective is actually to earn better than the market, right? Your objective is to earn better than the index. You want to beat the index, generate an alpha. So as compared to an actively managed fund where really the stock selection is the way to achieve outperformance, here it is by design that you outperform the Nifty index and generate better returns for your portfolio. What is Nifty Enhancer MLD? The objective of Nifty Enhancer MLD is to provide higher level of participation even when the Nifty was to grow in a slow manner. Suppose if there is a product which says that in next 3 years, for every 1% gain in Nifty, the investor gets 350% participation. And let us say this product has a capping of 15% on the Nifty growth, which means the investor gets 3.5 times of 15, that is 52.5% return, right? So the objective here is that when the markets become overvalued or markets get into a zone which is higher from a P multiple perspective, where we don't know the effects of the global issues in terms of whether the war or the inflation or the interest rate or the slowdown in China, probably a recession in US, this product becomes much more attractive, because for it to generate 52.5% return, the Nifty is required to grow only 15%, that too in 3 years time. But you don't compromise on your returns. 52.5% return is roughly about 15% CAGR. Now, how is this made possible? When you invest 100 rupee in this product, 71 out of 100 will be deployed in such a way that it generates 12% rate of interest. Let us say as an NBFC, it is lent out at 12% rate of interest. So when you compound 71 rupee at 12% rate of interest, it becomes 100 at the end of 3 years. The remaining 29 is deployed between the current Nifty level and the 115% of the current Nifty level in the Nifty derivatives transactions in such a way that if Nifty indeed grows 15%, you will get 3.5x of that. So 52.5 rupee comes from there, 100 rupee comes from the lending activity. So both put together, you get 152.5 at the end of 3 years. Now, as against this, suppose if the Nifty was to generate negative return, because Nifty is lower than the entry point, let it become 0. But the 71 rupee that you have has grown up to 100, and therefore that will ensure that there is a principal protection. Even if the Nifty was to grow slow because of the global problems, the investor need not be settled with a lower return on their portfolio. What is dual advantage MLD and how does that work? The objective of dual advantage MLD is to generate higher of the fixed income or Nifty link returns. Now let me tell you how does that work. For example, if there is a product which says that in 2 years time, if Nifty goes another 10% or lower, you will get minimum of 10% return. So in a way, that 5% per annum or 10% for 2 years is like equivalent to what you would have got from your fixed income investment. So this is the minimum that you get from the product. On the higher side, the product says that if Nifty delivers between 10% to 30% return, then you get the actual Nifty return. So if you think about it, the product is designed in such a way that whichever asset class performs better than the other, that is, if the Nifty delivers more than 10% return, then you get the Nifty returns. If the Nifty delivers less than 10%, including negative returns, you get minimum of 5% per annum, that is 10% absolute coupon for 2 years. Now, how is this made possible? When you invest 100 rupee in this product, issuer deploys 90 rupees for lending activity at 12% rate of interest. So when you calculate 90 rupee growing at 12% per annum for 2 years, it will become 110 at the end of 2 years. Out of the remaining 10 rupee, the derivatives are done in such a way that if Nifty indeed generates any return between the 10% and the 30%, the product will have actual cash flow, that much cash flow coming in from there. So suppose if the Nifty was to deliver 25% return, 110 comes from the fixed income activity and the remaining 15 comes from the derivatives activity. Both put together, 125% will be 125 rupees will be given to the investor as their return. Now against that, suppose if the Nifty was to generate negative return, then the 90 rupees will grow to 110 and that 10 rupee will be used as a minimum return to the investor, right? So in both the scenario, the investor tend to benefit without deciding an asset class. The product is designed in such a way that you don't have to do an asset allocation. Whichever asset class performs better, you will automatically reward it with the returns linked to that asset class. Abans Global Arbitrage Opportunities Fund is a dollar-denominated arbitrage fund being offered by Abans International Limited, which is registered in Mauritius. There is a collective investment scheme regulation in Mauritius, and Abans International Limited is registered under that as an expert fund. The fund basically focuses on arbitrage transactions in commodities and currencies in the global market. So there are multiple commodities like base metals, precious metals, etc., which trades in the global market, and then there are currencies which trade on the global market, the futures contract on that, the derivatives contract on that which trades on the global market actually generates arbitrage opportunities. So the fund focuses on generating stable returns through the arbitrage transactions. The fund has been there for last 6 years now and has been generating close to about 8% returns in dollar terms. So far as the investment strategy is concerned, just to give you an example, let's say copper trades on London Metal Exchange and Chicago Mercantile Exchange, or COMEX as it is popularly known as. So the future contract on both the exchanges, if there is a price difference between the two, which usually follows a mean reversion arbitrage, which means if LME minus CME copper, let's say the price usual price difference is say $30, if there is too much variation to that can be played as an arbitrage. Commodities arbitrage is not a perfect arbitrage, but it's a mean reversion arbitrage. Similarly, on the currency side also arbitrage can be traded. For example, INR USD as an exchange rate on the futures contract of this trades on two different exchanges. On one hand, you have the Dubai Gold and Commodity Exchange, that is DGCX. On the other hand, you have the Singapore Exchange or SGX. Say if DGCX currently is quoting say a January expiry contract at say 82 rupee 90 paisa, and if the SGX is quoting say 83 rupee, that means you can go long in DGCX, go short in SGX, and can pocket the 10 basis points of difference. That is an arbitrage strategy. So these are the type of transactions that Abans Global Arbitrage Fund does. So the fund follows stability, liquidity and return. That as a priority so far as the fund management is concerned.